Well, good afternoon, everybody, and welcome to this month's webinar as part of our Grow Your Law Firm series, Fixing Your Profit and Cash Flow. So thank you for your attendance, and hopefully with the change in daylight savings, we haven't had any confusion in terms of the Queensland start time. So today we're going to talk about the what I see in firms and what I see in terms of their numbers and what that means for firms in terms of action plans that they need to do to fix their profit and also fix their cash flow. And being a chartered accountant and the lawyer's accountant, what I start with always is the numbers. And whilst I like to think that I'm a little bit different than the usual accountant, fundamentally it comes back to what the story is that those numbers tell me. So today we're going to go through a little bit of an exercise where we're going to do some analysis of some numbers on a firm, and then we're going to be talking about by using the maths and then driving activities that change the results, the mathematical results, how those activities can drive improvements in profitability and cash flow. So it's not going to be too much of a theoretical session today. It's going to be as practical as I can make it with the constraints that we have in a webinar. So let's get into it. So today we're going to be focusing once again on the business planning part of your financially well-organised strategy. We're going to be looking at what you need to do to drive improvements in your profit and cash flow. But as always, I'd just like to start with a couple of quick polls just so I can get a little bit of a feel for who we've got listening in today. So I've just launched that. If you could just please answer what type of firm that you currently work in out of that selection. Excellent. Just a few more seconds, so if you can just update that. Great. Thank you very much. So today, who we've got on the line is we've got about 31% sole practitioners, 44% 1 to 3 principal firms, and 25% plus 3+ principal firms. So irrespective of whether or not you're a sole practitioner or in a smaller number of principal firm or a larger number of principal firms, the concepts that we're going to run through today are absolutely relevant to every single firm. In terms of you personally, what best describes you? You're a principal, are you a non-principal solicitor, or are you a CEO or a practice manager, general manager, and so on? You can just update that just to give me a bit of a feel for who our audience is, so I can make sure I tailor things appropriately. Thank you very much. So online today we've got 61% principals and 22% being CEOs or practice managers. And then we've got some solicitors non-principal here as well. So welcome. So for your non-principal solicitors, this hopefully today will give you a really good understanding of what some of the drivers are that in your firms they need to be focusing on, and why you may have certain requirements for achieving sort of daily outcomes. And for the decision makers, the principals and the CEOs, this is going to be hopefully an informative session for you, so you can really give you a few clear numbers that you really need to be focusing on and driving in your practice. And lastly, I'd just like to get a bit of a feel for who's attended before. So have you attended any of the Grow Your Law Firm webinars in the past that we've been conducting over the last 18 months to 2 years? Fantastic. So thanks for that. Well, this is great. We've got 84% of our participants today are returning webinar attendees. And for those of you who are new to my webinars, welcome. I hope you take a lot out of it. I run these every month on different topics. For those of you who've attended before, depending on what you've attended, what I've tried to do with this webinar is I've tried to sort of enhance and develop some of our other core ideas that I've been putting forward in previous webinars to tie those in with you. So let's get into it. So what's it all about? How do we make money? Well, really, it's quite simple. Professional services firms, legal firms, it's a matter of just doing the work and getting paid. So if we look at how we do the work, that's really just around what our profit is, and how we get paid is how we manage our cash flow. So in terms of developing your plans and your strategies in your firms, you need to really make sure that these two key areas are mapped out regularly as a minimum on an annual basis, but you also need to be looking at things quarterly and monthly so that you've got a very clear perspective on what your profitability needs to be, what those activities are that you need to implement in your firm to drive the profit, what are those things that you're doing within your firm that are actually holding you back from making the profit that you should be, and then what you need to do to structure your activities to drive improved cash flow. Because at the end of the day, you can make profit and send the bills out, but unless those clients are paying and paying when you want them to, you will find yourself in some cash flow crisis at some stage. So what I see in firms, so over the years I've been reviewing many different firms, and what I see in most firms, whether it's a sole practitioner firm or whether it's a 3 principal firm or whether it's a 10 principal firm, I see exactly the same trends. Sometimes there's a little bit of variation, but I see with the majority of firm the exact same trends. What I see often is a gross profit from 50% to 60%. And I'll show you in a moment, but gross profit basically is the revenue, the professional fees, excluding disbursements, minus the direct labour cost for fee earners. So excluding principals, but including your legal support, like your paralegals and solicitors and so on, excluding the costs of receptionists, practice managers, and so on. So I see this number often, 50 to 60%, which is the main driver why firms aren't making the profitability that they should be making. I see significant variations in this gross profit over areas of law. I see some areas of law driving much higher GPs than other areas of law. Take conveyancing, for example, much lower amounts of GP to other areas of law within that practice, maybe family or commercial or PI or so on. And what I find with firms is they don't understand this. They never actually sit down and have a look at these numbers and say, well, what are these areas of law producing? What changes do I need to make within these areas of law so that we drive a combined strategy around achieving profit targets? Often things are looked at globally in firms as opposed to breaking it down into where the bleeding is actually occurring and then needing to address those brutal facts. I often see high principal productivity and low fee earner productivity. This is probably one of the main drivers for lower gross profit in your firm. Gross profit, as I'll show you in a moment, is the key. It is the key driver around profitability in firms. It's not to do with overheads, it's to do with this GP. So I see principals working hard, but I see low fee earner productivity, either through support staff or through solicitors generally. I see very poor recovery of fee earner WIP. So generally I see principals charging out the work that they do, but I often see that there's discounting of that WIP when it comes to issuing the fee. And that being made via a judgment call. So that really drives down that gross profit. I also I also see, and this is particularly the case in smaller firms, so for the sole practitioner and the lower number of principal firms, this is something that is just, I think, is rampant within your practice size. That legal support staff are not being charged to clients. Often in cost agreements, you've got the opportunity to, but you just choose not to. And often that means that there is a significant amount of revenue that just continues to be left on the table that the clients don't pay for. And if you've listened into some of my previous webinars, and one particularly, if you wanted to go onto my website, financiallywellorganised.com, go to the latest tab, and you can click on law firms and or webinars, and you'll see all my previous webinars. There's one there on pricing and understanding pricing. And I just want to say at this juncture that the pricing is a bigger issue in your head than it is in your clients. The reason that your clients can be sensitive to it is because you are sensitive to it. So pricing is just a normal part. So you need to be really, maximizing your revenues that you're charging to clients and believing in that. And what I also see is an indiscriminate use of time costing. I see in firms where some areas use time costing well, some of them don't. Now, look, time costing, it's a necessary evil. But what you need to do is you need to use it as a guide for what you build. And because unless you're a fixed fee firm, and I even say to fixed fee firms, you should still be using time costing so you can actually assess the profitability of each matter. But what I see in firms is I see this indiscriminate use, which means that you've got some parts of firms, some areas of law within firms, some departments, some principals who don't use time costing. Some are areas that do. And when you're looking at making decisions around what we should be doing in our practices, what we should be doing around what activities we've got to change, then unless you've got real data that you can use, which is what time costing gives you. So sorry guys, putting my accounting hat on here again, but you're making decisions then based on real empirical evidence, not making your decisions on gut feeling. I often say to people that hope is not a strategy. And what I see in firms is they're making decisions, or sometimes not making decisions because they don't have the data and understand the data to support what decisions they need to be making to get that outcome that they want. So that's just a quick snapshot of what I see in firms. And really the actions to improve it are quite simple. So let me just take you through gross profit. So first of all, you've got this chunk of revenue that you make each year. And out of that revenue, you've got to pay for everything. And what you've got left over, whether it's being paid to you or not by your clients, is your profit. But the key variable that you have in your firm is the relationship between this direct labour that you pay for, so the people that actually produce your revenue, so that's your fee earners. And when I look at your direct labour cost, I include paralegals, but I exclude principals, because with principals, you've got a bunch of other things that you've got to do in your firm that's not just around driving revenue. So when I look at direct labour cost, I take the principals out of it. And then that gives us what's called a gross profit. And when in the firms that I see that are good, profitable, successful firms, I see this gross profit figure number to be 75% plus. So really what that is saying to me is that the amount of revenue that they generate is generally 4 to 5 times the amount of their direct labour cost. And then out of that, if you've got firms that are generating those sort of levels of revenue, their overheads are relatively fixed, which produces a good GP. So as a benchmark, a bottom line benchmark, you should be starting to think about what are the activities you've got to be taking in and actions you've got to be taking in your practice to get that GP to 75%. And really, there are only 3 ways of doing that. You can increase your revenue, you can reduce your direct labour cost, or you can do both. But in terms of what areas, that's got to be the question. What areas of law, what parts of the practice do we need to make some decisions in that is going to drive these outcomes? So let me give you some numbers. With this particular firm, actually what we might do is we might just go back one step to start with. I'd like to get a little bit of a feel by just running another quick poll. here around where you think your GP is at within your firm. So remembering this data is all anonymous. So just tell us a bit of just gut feel. Don't need to do the maths in your head, get your calculator out. But we're only going to spend a very short time on this. But I just want to get a bit of a feel for where you see your gross profit is. So your total revenue, professional fees that you make, minus your direct labour cost, including all fee earners but excluding principals. And yeah, interesting. I'm seeing these numbers. I'll put them up in a minute. We've just got a few more people to vote there. These numbers are coming in exactly around what I've been seeing myself over the years. So thanks for that. So very few firms achieve that 75% plus GP. 9% of those firms that are listening today see that their GP is at 75% plus. Now, look, that's very normal. We've got the majority, 60% in the 50 to 75%. Maybe it would have been interesting to see if I would have made that a little bit lower than 74, but 30% are in that 50 to 60% bracket. So what we've got is we've got a whole pile of firms that are out there that are underperforming in terms of their GP. And what that does, because of the relationship between your labour cost and your revenue, being your labour cost is too high for the level of revenue that you're generating, what it constantly does, it puts pressure on the business to drive to drive volume to produce greater profits. And as you know by now, the lower the profit, the gross profit, the lower amount of that GP you've got to cover your overhead and then take out as profit at the end of the day. So look, thank you very much for that. But it's so for those of you who are listening with your GPs that are less than 75%. And I'd expect that there'd be a reasonable portion of that would be in the sort of 60 to 65% from what I've seen. What I want you to do out of today is to think about what your actions are around analysing your empirical and getting empirical evidence so that you can make decisions around what activities you've got to specifically implement to drive improvements in this GP. So let's take a quick look at some numbers. So here's an example of a firm, which is very typical of what I see in firms where there are multi-principal. So in this instance, it's a 3-principal firm where they operate over multiple areas of law. So this particular firm has revenue of about $2.3 million. It has a direct labour cost, excluding principals, of about $845,000, which produces a gross profit of $1.45 million, or 63%. It's got 16.3 fee earners, including the principals, which produces 27,254 available hours. Now, this is a really important number that you've got to know. The number of hours that you pay people, you need to understand what that cost is per hour, because whether you're somebody who's charging revenue or not to WIP, you've still got to pay them that amount. So you've got to look at not just the amount of the cost of that labour is that you're paying to them for the hours that they're charging, but you've got to look at what the cost of that labour is for the hours that they're working. So in this particular firm, that cost is $38 per hour. And when you look at the total number the revenue earned per hour for all fee earners that are available, it's only $84. Now, interesting, just so you can understand, and I don't want to confuse you too much, but 84 minus 38 doesn't equal 53. And that's because in calculating A84, we include the principals, the principals available hours. In calculating the 38, we only use the cost of the fee earners available hours. So when we look at our gross profit, what it is this 1455 million divided by the total number of available hours. So what we're doing here is we're going to get a feel for what are we making out of every hour. Now this number by itself is the most critical KPI that you need to measure every month as a minimum in your practice, because if you can manage to increase your average revenue per hour and maintain your average cost per hour, but may reduce your number of available hours for fee earners, then what that is going to do is going to drive growth in your gross profit. I'm going to show you that in a minute. But let's break these numbers down a little bit. So we see a real spread of revenue over these different areas. But when we look at what the gross profit is, we see a significant variation, from 44% to 84%. So a GP in commercial of 74% right there, 44% in conveyancing, 84 and 54 in family. When we then break that down and we have a look at what the hours are that we're physically paying for the people to work in those areas, and also an allocation of the principal's labour input or focus in these areas, what we can see is that we get significant variations then in our average rate that we generate per hour per area of law. So even though we've got an $84 average rate, which is in my view extremely low, so this particular firm should have capacity to generate revenue of about $3.5 million, which is simply how many people by how many hours available, by how many they're expected to charge to whip, 4.5, 5, 6, whatever it might be per day, multiplied by their charge rate. So this firm has got a very low GP here because they carry way too many staff for the level of revenue that's being generated. So their capacity is way over and above what they're actually generating. But if we have a look at it, if we were just to make a decision, say, look, we've got to crack down on this across the firm, and we need to get some strategies to drive that average rate per hour up. Well, really in the estates area, we don't really need to worry about that greatly. We actually see that it's got a higher average cost per hour paid in that area, but it produces by far the highest gross profit per hour of available hours, which is great. So what we should be looking at doing is in saying, well, what's working in this part of the firm? How do we change that, say, to the family part of the firm, and say, what have we got to do to get this $79 per hour up much higher? What have we got to do to get this gross profit per hour much higher? And it's really just the relationship of that. And if you look at the number of fee earners, we've got 6.8 fee earners generating 900 grand, as opposed to 2.2 fee earners generating 600, 5 generating 450, and 2.3 to 350. You can see that the leverage in this part of the practice is working so much more efficiently than the other parts. So critical number to understand, critical information that you need to have on hand before you start making decisions around what you've got to do to turn your profitability around. So the number one activity to drive changes in profitability is make decisions around driving average revenue per hour higher and driving or lower or maintaining your average rate per hour of labour paid. So let's take those numbers a little bit further and just sort of see what might be possible in this firm. So I'm not going to do this on an individual basis, but just if you can use that as the context of where we've got to look at specific activities to drive improvement in specific areas of the practice. So we've just got a little bit of a calculator here. So we've just taken through the numbers here for this particular firm in relation to that P&L that we just had. So looking at those average rates, looking at the number of people and our gross profit. So what I've said as an observation in this particular firm is that they're overstaffed. They've got capacity there to generate about $3.5 million. But they are only generating 2.3 million in professional fees. So one of their actions has got to be to improve improve that ratio of people to revenue. So let's say in this particular firm, they decided they needed to drop their number of people by 1.5. So if they drop their number of people by 1.5, what that does, it drops $95,000 out of their labour cost. What it also does, it reduces their number of available hours. So the number of hours that they generate that they've got to pay for, from which revenue is generated, reduces. What they also do is they want to implement strategies to drive an increase in their average revenue per hour. So one way of doing that might just be because you are spreading and generating the same revenue over lesser number of people. But actually, I think the number there works out about 10%. So you can see there that to achieve the same level of revenue, it's a couple of grand out, but the same level of revenue, your average rate will automatically increase if you can spread that workload out over a lower number of people. But the impact of that is it puts another $90,000 worth of profit into the bottom line. But there might be other strategies that the firm can implement, and I'll go through some of those in a moment, that you can also do to drive up that average rate per hour. So let's say in this particular instance, we wanted to drive a 15% increase. So to get our average rate up from 84 to 97, I've shown you all you need to do is spread that workload out amongst a smaller number of people. And there's obvious capacity there because these guys had $1.2 million of surplus capacity. And then what you've got to do is implement some other strategies around raising that average revenue per hour. And that might be simply by capturing more of work in progress via improvement in productivity and time recording. But it might also be around increasing prices. It might also be around implementing specific sales strategies within your firm. But there's a whole range of ways of doing that. But the point that I'm wanting to make here is that to drive what's almost a $200,000 improvement in your gross profit, and assuming that your overheads have stayed the same, but by making specific decisions here around what we've got to do to drive our revenue up and apply the maths around how we get that average revenue per hour up, and by driving and lower and we can see that we've maintained our average cost of labour, but just reduced our number of available hours because we've got surplus capacity. We were able to put nearly a $200,000 improvement into our gross profit with no extra overheads. That drops straight down to the bottom line as profit. And on a percentage basis, that's about a 14% increase in gross profit. If this firm, let's say, had $700,000 of overheads, which meant that it had roughly $1.45 million worth of net profit before principal salaries, $755 before principal salaries, then that would produce about a 26% increase in that net profit before principal salaries. Now, those results are not difficult to achieve. It's a matter of making the right decisions in the right areas, focusing on managing that ratio of recovery of revenue out of our labour cost, the two key numbers. So that's just something for you to really think about. And you can see here that just graphically that just shows that $200,000 increase, assuming that our and if that was cash flow and our debtors and WIP stayed the same sort of ratios of 45 days and 57 days, that's another $196,000 worth of cash flow into the firm. So just going back now to have a look at what it is that you need to be doing. So these are the actions that most firms need to do to fix their profit. One is that right ratio of fee earners produces the right average rate. This is the number one reason why firms struggle with their profitability. You need to sit down and work out the maths. It's looking at this thing. What are my areas of law? What is the revenue that's generated out of it? What is the direct labour cost? Now you depending on your practice management software that you use, this data is always in there. And even if it might not be 100% able to be just pulled straight out, just with some analysis, you can assess this data, and you can then start making an informed decision. But do the maths first, so that you're not just making assumptions and you're not just implementing that great strategic objective of hope. So that was sarcastic, by the way. What you then need to do is work out what your activities have got to be to increase your average rate and to reduce your fee earner numbers. Okay, and so that the net result is a driver of an improvement in that gross profit. Really, I see the two main areas are improvement around productivity. What I see, as I said before, is high principal productivity, low fee earner productivity. It's the fee earners, non-principal fee earners that are the costs that you've got to outlay in your direct labour costs. So what you've got to do is you've got to get very clear with your fee earners around what their expectations are around productivity, meaning how many hours are you expected to charge into WIP every day. And if people are busy doing client work, then they should be putting all of that into WIP. Doesn't mean you've got to ultimately charge it to the client. You can write it off if you think it's too much later. But you've got to get this mentality with your team. You need to be getting these numbers into WIP. You need to be efficient with your work, but you need to get it in WIP. Now, 100% time costing. So that's if your time costs. For firms that just work fixed fee, I also say to you, time cost. You need to know how profitable each matter is. But you can't be a half time cost firm or any other variation. You either don't time cost or you do time cost. If you do time cost, then you can start understanding what the numbers are telling you. You can then make decisions based on empirical evidence across the firm. And you need to have for your people and yourself weekly reporting on productivity, so that they know where they're at against the expectations that are set for them. The basic expectation is you're paid a salary to do this, and I need you to generate these numbers of hours at this rate into revenue. Remember, it's just maths. How many hours do I pay for? How much revenue do you have to generate out of that? You then need to also focus on improving recovery. The key when I say recovery, is billing what's in WIP. Okay? The key action for improving recovery is better client engagement. The more time you spend engaging your clients at the front end, so that they clearly understand exactly what your engagement expectations are and what you're doing and how you're going to be charging them, the easier it is to bill it. Use this philosophy. Bill it if it's in WIP. I often say to firms, what I see is that most bad debts get written off before the bill's even sent to the client. So step one is people don't actually put it into WIP. They're making an assessment at that point in time that the client won't pay, so I don't put it in WIP. Then what has happened is that WIP is then discounted back to what a different fee amount. So then before that bill is issued, they're making a decision to put that client's not going to pay. So you're writing off all of that time that's actually being done and worked on a client's affairs before they even send it. The reality is around billing, as I said before, price is a bigger issue to you than it is for your clients. The engagement is the key to it. But if you don't put it out there, you'll never know. From my experience, most firms that just bill what's in WIP, it acutely attunes efficiency, but also it's only a minority of clients that end up complaining about fees. Systemize things so that you can improve your efficiency as well. But most of all, what you need to do is something different to get a different result. So take some action, work out of these what is the number one thing that you need to do in your firm, in your different areas of law, to drive improvement in this gross profit and those hourly rates, and just focus on that one thing. If it's productivity, if it's recovery, whatever it is, what you need to do. If we're overstaffed, make a decision, get a different result. So cash flow, moving on. What I see in firms, I see extremely poor client engagement. And what I mean by client engagement is not just sending a cost agreement out, it's how you actually engage with your clients around the fees that you're going to be charging and how they have to pay you. I see a very unstructured billing policy. So it's for one principle, this is how they bill, another principle, this is how they bill, this is how the authors are billed. I see that in a very unstructured manner. The reality is that structure determines behaviour, and the more structured you are around a billing process and what the policy is in the firm, the more predictable the amount of revenue is that you're going to generate. So it comes down to put your time in a WIP, charge and bill what's in WIP, and that gets billed in this manner at this timing. The more structured you are, the easier it is to manage your revenue. I see minimal data collection processes in firms. So you've got firms that just really don't have a structure around how they collect their debtors. They really just let clients pay when they can, and when cash is a bit tight, it's at that point in time they get in contact. I also see that within firms there's an ease or even an acceptance of writing off bad debts. Well, bad debts happen because you've had poor engagement, you've had poor scoping, you have an unstructured billing process that doesn't meet the client's expectations, and you don't have a structure around ensuring that those debtors get collected. So that's what I see, and I often see poor funding structures. So I see firms that are growing their WIP, particularly litigation and PI firms, where it might be 18 months to 2 years for that matter to settle. And what I see is that they're just funding it out of their profits instead of going to the bank and getting some funding. Have a look at my webinar on funding a legal firm. But banks will lend you money to fund your business, and they have policy around that. But you don't have to do it out of your own profit retention. And that's what puts the pressure on your firm from a cash flow perspective. That's what drives the behaviours in the firm to worry about how am I going to pay that bill next week. So the two drivers of cash flow are your work in progress and debtors. And basically, work in progress is the amount of time that's charged into WIP before you bill it, and then the debtors is once you bill it, how long it takes to get paid. So this is just a typical example of a normal billing cycle within a firm, and I call it the cash gap. And the cash gap is the period of time between when your cost agreement signed. So that is the point of time when a client says, or you've got instructions, the client says, do it, and to when you receive the cash. So in most firms, they don't manage this process very well. The key to improvement in cash flow is to reduce this period of time. So you've got to reduce the cash gap. So build systems and processes in your business to drive a reduction in this period of time. So take, for example, we've got a cost agreement signed, and then 15 days later, we've got the engagement commenced. And then 45 days later, the engagement's finished and it's billed. So there was nothing taken into trust in this example. So it's 60 days between when a client says, I want you to do it, and when you've actually finished the work. But after that first 15 days, you're incurring expenses, say labour expenses on doing that work. For the whole of that 60 days, you're actually incurring other expenses, rent, leasing, you've paid for your insurance, all of those sort of things. Your receptionist and practice managers' labour cost. So you've got 60 days of incurring costs, which in a legal firm, there's not much credit. So most of it is going out, every fortnight or every month in advance for rent even. So you've got to fund that. And then what it takes is 45 days for that money to be paid by the client. Now, I can imagine a few of you, if you're there with other people in your firm, you're looking at each other and saying, God, I wish my clients would pay within 45 days. So the longer this period is, the bigger the cash gap and the harder it is on your cash flow. So what you've got to do is you've got to think of what the activities are that are going to drive improvements and drive down these days. So I'm just going to go back now to our spreadsheet and just continue on with our analysis of this firm. So I'm just going to take these numbers out. So what we've got in this particular firm is out of a $2.3 million revenue, they've got work in progress of 285,000. And what that means is they've got 45 days. So 45 days out of 365 days of revenue has been locked up and unbilled yet, so it hasn't turned into cash. So from a debtor's perspective, you've got $360,000 or 57 days in their debtors, which means that out of this revenue of $2.3 million, $645,000 of it is waiting to be billed and or collected. So if we go back to our cash gap, sorry about that. If we go back to our cash gap here, this period of time here is the growth or the value of your work in progress and the value of your debtors. Okay, so in this particular firm, that's 102 days or 28% of revenue. So if we were to drive some changes in this firm and let's say implement strategies to reduce those work in progress days down by 15 days back to 30, so all you're carrying in your practice is 30 days. Just these. So we've got the same numbers up here. Then what that does, it puts an extra $94,000 of cash flow, into cash flow, improves your cash flow because you're going to have billed this out, which then gets collected. So your WIP drops by 285 down 190. And so that produces that additional cash flow. If you ignored that one and just said we're going to focus on our debtors and we're going to get those debtors down by 12 days, down to 45 days, then what that produces is an improvement of $75,000 because you've got that cash in faster. So combining the two with specific strategies that are around how you bill and when you bill, so we get our WIP days down to 30, and then specific strategies around engagement and when we bill and how we bill. If you bill your clients smaller amounts more regularly, they'll pay you faster. And having very structured strategies around how you collect it, what that does overall is puts an additional $170,000 of cash flow from the same profit into your bank account. So the importance of implementing strategies in your firm to drive improvement in WIP days and debtors days, or your WIP balance and your debtors balance, can have a significant impact on the level of cash flow that you generate. And at the end of the day, it's the structures that you implement in your business that drive the behaviours that produce these results. So let's go back to our level of profitability and just pop in what we had before. Minus 1.5, and we had a 15% increase in our average rate. So with this particular firm, if they were to drive actions around getting better ratio of fee earners to revenue and getting more recovery out of those existing team members, but also driving strategies to improve our average revenue per hour to produce an extra $196,000 worth of profit, 95 of which just came from reducing the direct labour cost, and then drives our WIP days and debtors days down to 30 and 45. What that produces in terms of additional cash flow for this firm isn't $196,000 just of profit, but an extra $346,000 of cash flow in year one if they were able to achieve that. So when you look at that $346,000, part of it's made up of profit improvement, part of it's made up of WIP improvement, and part of it's made up of debtors improvement. So critical that you've got to focus on all three. So things that you need to do in your firm around driving improvements in your cash flow. So what are you going to do to reduce the cash gap? Always engage your clients around costs. if you don't have to send a cost agreement, make sure there is some documentation where you manage their expectations. Make sure that your cost agreement is plain English. Chances are they won't read it anyway, but make sure if they do read it, they understand it. Make sure you've got a plain language covering letter that specifically addresses these things for clients so that they know what they're buying and it's front of mind for them. This is my estimate of fees. This is when we're going to bill you. These are our payment terms, and this is what I want in trust. And be rigid about it. Do it the same thing for every client. No variation, because it's the variations that cause the problem. But what happens is not having this structure in terms of your client engagement is the norm in most practices. Turn the structure into the norm, and then you're going to see significant results. So that's all about what you're going to do at the front end with the client. Then when you bill, turn it into an administration function so that your billing is actually done by your administration team members, not by the authors. Principals and authors are the worst billers. They have an emotional attachment to the cost, and depending on what they think about the results or the emotional conversations they've had with those clients, that'll really drive the amount that gets billed. So get it out of their hands. Create an administration function around this. And then focus on weekly trust withdrawals. So your money in trust, pull it out. Very normal thing. But the trouble is, it's often a minority of times that money is put in trust in firms. But if your money is always put in trust, your clients have got some cash there, your cash flow is just going to improve. And then get yourself a dedicated data collection person. So a non-author, non-principal. Just like from a billing function perspective, collecting cash, the authors are the worst at it. It's not their focus. Their focus is on doing the legal work and getting the results for the client. And they don't want it. They don't like having conversations with clients about cash. So build a system where you've got a dedicated person. They don't need to be full-time and it's relevant for your business, that all they do is they have a responsibility for collecting debtors. And if that means they've got to do that one morning a week, one day a week, then that's what they do, and they follow a process. So implement those things. They're the keys to driving your cash gap down. So as always, what I'd like to offer to everyone who's participating today, for the first 15 to email me today, I'm going to run through a free 45-minute online meeting with you to fix your firm's profit and cash flow. And what we're going to do is I'm going to get you to provide me with some high-level numbers that, that will be along these lines. And if possible, a little bit of a breakup in terms of areas of law. If we can't, we'll just do high level like this. But really to have a look at what your key profit and cash flow drivers are, have a look at what the story is that they're telling me, and then we can have a conversation around what are the key areas, what's happening in your firm to drive improvement in this. So all you need to do is just email me at matt@fwo.net.au, and we'll get that meeting booked in. I'll send you out a very simple little questionnaire. Won't take you more than 10 or 15 minutes to get the data together on it, and we'll use that as the basis of our meeting. Also, I've got my next Grow Your Law Firm webinar on next month, Wednesday the 20th of November, starting at 12 noon Eastern Standard Time. So for those in New South Wales and Victoria who are listening in, that'll be 1 p.m. your time, and it's on building your revenue. So we're going to be talking about strategies and actions in your firm that you need to focus on to drive growth in your revenue. I'm going to give you some key activities that you can do to implement that. You can register now at financiallywellorganised.com, our website. You'll also be reminded and invited to that webinar via email closer to the date. We have our next FWO Growth Club group starting on Monday the 11th of November. We've only got 2 spots remaining for that group, and so if you're interested, please email me today or soon. Basically what we'll be doing is is locking those couple of spots in over the next week or two. And basically, the FWA Growth Club is where I get like-minded firms together where we work on strategies to drive profit and cash flow. I'd start by doing a full on-site profit and cash flow review and planning session at your firm. We dedicate a whole day to that so that you've got a clear understanding in detail. I do this myself in detail of those key practice areas, what the profitability issues are, what the story is, and then we map out some targets and plans and actions around your profit from a production perspective, from managing your relationships with clients and cash flow that you need to start implementing in your practice. We then also work through marketing and sales strategies and development of your strategic plan for the future. So if you're interested, just email me at matt@fwo.net.au and we can have a discussion about getting that organised. And as the lawyer's accountant, the range of services that we provide to lawyers and to legal firms is our annual accounting service, which is fixed fee, paid over 12 monthly instalments throughout the year. All accounting and compliance needs are handled, and you have unlimited telephone calls and email. Also, hop onto our website, financiallywellorganised.com, and register for our legal firm membership. It's a free membership if you're interested. There's no obligations out of it, but there's some real value that you'll receive out of that. So even if you're not a client, you'll still be able to contact me about anything and ask me anything in relation to your firm. And then we've just run through the FWA Growth Club. So look, thank you very much for your attendance again today. Hopefully we'll see you back next month for building your revenue in your firm. In the meantime, if there's anything you want to discuss, please give me a call. Please take me up on my offer for a free 45-minute one-on-one planning meeting to review and assess your business around fixing your profit and cash flow. Thank you very much. I'm Matt Schlyder, the Lawyer's Accountant.